Now, the Bank of Canada has met again, and they decided to leave the overnight rate unchanged. Now, they meet every 6 weeks or so to determine the future of this rate. Now, before I get started, I want to explain a bit about the different rates that are out there. And this can be a little bit confusing, so I want to give you a bit of information first before I get to some of the details. Now, the policy interest rate versus the prime rate. So the Bank of Canada controls the economy with the policy interest rate, also known as the overnight rate. That's currently at 1.75%. The prime rate is directly influenced by the overnight rate, and this is the rate that us as consumers, we borrow from. Okay, so your variable rate mortgages are all priced from the prime rate. So more about the overnight rate. The Bank of Canada will cut rates to stimulate the economy and hike to slow it down. Now, this is the rate that major financial institutions use to determine their lending rates for us consumers. So the Bank of Canada, as expected, they held rates as is. Now, they've hinted today that lower rates could stick around for the rest of the year due to a bit of a dim economy. Now, some economists say that we could even see a drop in this prime rate this year. Okay, so fixed rates, where do these all fit in? So we've talked about the floating rates, which is the variable rate mortgages, which is directly relates to the prime rate and the overnight rate. So the fixed rates, where do they fit into all this? Okay, so bond yields are directly related to fixed rates and how they're priced. Now, because the economy is looking a bit dim, you're seeing the bond yields drop. Okay, so this is 2018. So back here, the economy is doing really well. The Bank of Canada is saying we're going to increase rates 2 to 3% over the next 2 years. The economy is looking great. And you can see as they increase rates, the bond rates or the bond yields go up as well. And directly reflecting that is the fixed rates are going up at the same time. So what you've got here is the economy is doing great, everything's fantastic, and then around Christmas time or pre-Christmas, they come out and they say, well, things aren't looking as good as they should in our economy. So now at this point, you see the bond yields start to fall. Okay, so right here we've got bond yields at about 2.4 to 2.5%, which equate to 5-year fixed rates being about probably 3.8 to 4%, so 5-year fixed rate. And then down here, we've got the bond yields falling, where we've got the yields now sitting at 1.5 to 1.6. So now we're getting 5-year fixed rates for about 3.09 to 3.25. Okay, so what does this all mean? Okay, so fixed rates, I believe, may fall further this year. So expect those bond yields to keep dropping. And if they do, then we'll see lower fixed rates. Now, this is ideal for variable rate mortgage holders because nothing changes for them. Okay, so nothing changes for payments or your rate. Now, this could act as a pressure relief for those entering into the housing market. So hopefully this stimulates the housing market a bit, and those people that are wanting to buy, they'll take action now. Okay, so this is beneficial to restructure your mortgage. Now, there's 2 reasons why. The first one is that this could act currently, because we're in a low rate environment, this could act in a beneficial way to act as an inflation hedge strategy. So you could essentially secure a rate for another 5 years at a low rate, at today's low rates. Another way of looking at this too is if you do end up doing that, you could restructure your mortgage and take any high interest debt, such as credit cards, loans, auto loans, and that sort of thing, and consolidate them all under one umbrella. Okay, so questions and comments, if you have them, don't hesitate to reach out. That's what we're here for. I hope this has been helpful. Have a great day, and we'll talk to you soon.